Now we're going to have a panel of lawyers. Still here?
The room just emptied.
Listen, without these people here, we can't get any transactions done. So they're here to talk about legal trends and insights for microcap issuers in 2024. Lynne Bolduc is going to be the moderator. I'm going to hand it over to Lynne right now. Thank you, Phyllis.
Thanks, Sean.
Good afternoon. Welcome to Trending Legal Topics in Challenging Markets. I'm Lynne Bolduc, partner at Fitzgerald Creditor Bolduc Risbro, with offices in Los Angeles and Orange County, California. I got my start in the financing world about 30 years ago as in-house legal and compliance at investment banks, where I learned from the inside what bankers and investors want to see in a company and how to structure deals that sell. I now run my firm's corporate and securities department, where we specialize in making financing transactions as simple as possible. We represent startups through public companies in all stages of their growth and development, particularly with respect to private placements, IPOs, secondary public offerings, uplistings, and SEC reporting. My firm is a full-service business law firm, handling everything businesses and their owners may need, including litigation, real estate, tax, and succession planning. Personally, I serve as an expert witness in corporate and securities cases and sit on the boards of directors of private and public companies. Now introducing our panelists, starting on my left, we have Richard Friedman. Richard is a partner in the corporate department at Sheppard, Mullin, Richard, and Hampton, where he co-heads the capital markets group and is a member of the firm's blockchain and fintech and ESG teams. His practice principally focuses on corporate and securities laws with a concentration on public offerings and private placements. His experience includes IPOs and SPACs, domestic and foreign reverse mergers, secured and unsecured private equity financing transactions, registered direct and shelf offerings. He represents issuers and underwriters in a wide variety of industries, ranging from technology to biotech, and including emerging sectors such as digital securities and cannabis. Next, we have Stephen Skolnick. Steve chairs Lowenstein Sandler's capital markets and securities practice, focusing on representing public companies, investment banks, and investors in capital markets transactions and securities law matters. Steve handles strategic mergers and acquisitions for both public and private companies, identifying and mitigating potential roadblocks to ensure swift transaction progress. Steve's expertise spans various industries, with a particular emphasis on life sciences transactions, where he collaborates closely with leading investment banks and issuers. Additionally, he advises companies and their boards on SEC compliance, disclosure issues, and corporate governance, while also counseling clients on federal securities law and regulatory frameworks, such as those of FINRA, NASDAQ, and the NYSE. We also have Christopher Tinen. Chris is the leader of Procopio's capital markets and securities practice, where he focuses on corporate and securities law, representing public and private companies, handling all aspects of securities law compliance, startup formation, and a wide array of financings, including registered offering, PIPEs, and venture financings. He has represented a wide range of tech startups in Silicon Valley and San Diego. Today's panel will be an interactive discussion of current market conditions for transactions, and we'll take questions at the end. I'd like to ask Steve to kick us off by telling us about deal structures he is currently seeing, as the market has been a bit challenging lately.
We could probably spend an entire 30 minutes on this, but it's an incredibly challenging market. We're seeing incredibly difficult deals. There's not a lot of money out there, and the structures keep changing. And so we're seeing warrants with anti-dilution provisions. We're seeing warrants with resets on reverse stock splits, and mainly because the number of the clients now with stock prices on NASDAQ below $1. Sure. Stock prices below $1 are seeing, potential splits coming up, and obviously, when you do a split to maintain your NASDAQ listing, your stock price generally drops after that split. So investors are now looking for protection if they're investing prior to a split taking place. We've seen not only full ratchet anti-dilution in the warrants, we've seen exploding warrants, meaning that the share number will also adjust pro rata proportionally with the exercise price adjustment down. So, when you hear from banks, we're going to do a common stock only deal in this market for microcap, that's just unlikely to happen. I think there are rare circumstances where you're seeing that, but it's incredibly rare. So the expectation is you're going to have warrants, you're going to have structured warrants, you're going to have 150 to 200% coverage on those deals. So we're seeing that in RDs, we're seeing it in pipes, we're seeing it in deals that meet the public offering exemption for NASDAQ and NYSE also.
What about the stock exchanges? What's your gentleman's experience been with how the exchanges, everybody's grinning, with how the exchanges have been dealing with the challenging conditions, and then all of these sort of gyrations that underwriters make our clients go through?
Are they in the audience?
Likely.
Yeah, look, please let my client through. No, so I think that it's a challenging market for all participants, including exchanges. They have a minimum quality that they want to maintain. If you're a NASDAQ or a NYSE and you want to make sure that your companies have a certain level of quality. So I know they're managing those expectations, and for us as, especially issuer counsel, we're trying to meet kind of those ever-shifting demands of the market alongside the exchanges. So I think, I counsel clients to just communicate, be upfront with the exchanges, talk about the problems you're going through, and try and work through them hand in hand with the exchanges.
So I'll add, it's a very broad question because there's two sets of different kinds of offerings you could talk about here. IPOs are one set, so exchanges and trying to get an IPO done and terms of an IPO are very different than listed companies and the deals that are getting done for listed companies. Sure. So on the IPO side, you're dealing with either NYSE or NYSE, like Amex, the MKT side, or NASDAQ, or now the CBOE as well. And so listing standards vary among each exchange. And NASDAQ, if anybody's trying to do a NASDAQ IPO, has moved the goalposts completely and upended the way things had been done. And when you get near the end, they want to see the lists of investors and want the bankers to give their lists before the deal's even gone effective or been approved. So essentially, they're asking bankers to tell them who they're selling it to before they're permitted to sell it. And they review and spend a lot of time thinking about whether that's good enough or whether the distribution's wide enough. And probably people have talked about it earlier today, so I won't go through that. NYSE, very different. They look at different issues and different things they ask about. It's a different process. They review you before you can even apply, so it's done differently. And CBOE, I haven't been through the process, but I know that that's also out there, and there's some companies that have listed there. And then I'll turn it over to you guys in a minute. But on the other side, the secondary offerings, it's very different. NASDAQ, it has the 1/8 rule, so every deal you're doing has common stock and warrants. Well, the warrants cost 0.125 or half a warrant's half of that. So you have to build it in, trying to do, if you're doing an at-the-market deal, versus an overnight when your stock runs and you have to understand the trail of your price and how you get deals done, versus NYSE, if you have a warrant, which you don't see many deals done like this, because NYSE makes you do a black Scholes on the warrant. I don't know what CBOE does yet. Not sure there's been a secondary on any of the CBOE deals yet.
I think one of the most difficult things that's happened over the last couple of years is the fact that, and again, this is not, NASDAQ changed their policy, right? NASDAQ changed the policy to going from a pre-approval of deals prior to a deal getting done to a kind of a self-policing by the industry of getting deals, right? So they were supposed to be looking at transactions after the transaction was completed, and the industry experts, the banks, the lawyers were supposed to kind of police that they were complying with NASDAQ rules. And it partially was because NASDAQ was having a hard time maintaining a full staff of people, too many deals happening, so they decided to go that route. And it really created mayhem in the market, because what ended up happening is people were doing deals that were not necessarily in compliance with NASDAQ rules for meeting, either whether it was a public offering exemption or an at-the-market deal. And what you would hear is, as issuer counsel, even you'd hear from the banks, well, we did 5 deals in the last 2 weeks that met, that were compliant, and we're like, well, not really, because no one looked at them. NASDAQ has now woken up, and they are starting to reapply their rules. The one thing that, as Chris mentioned, it's been hard to get NASDAQ to respond. It has been difficult. There are some advisors out there, but they seem to be a little bit more responsive. But to Chris's point earlier is that you really do have to bring some of these challenging structured deals in front of the examiners before, because NASDAQ has woken up and they are now starting to apply their rules, and they're not necessarily doing it across the board. But there are lots of companies looking at delisting because their requirements, their transactions did not meet the listing requirements or the exemptions that are available under their rules.
And this is after deals close.
Yeah.
And so there's not really a framework for unwinding a transaction which has already gone to market. So yeah, I agree. I think we're seeing kind of a rethinking, especially at the NASDAQ level, of how they manage this intake process. And it can be very challenging. You've completed the deal, you've raised the money, and then, I've had NASDAQ reach out 6 months later and say, check the math there, or let me see your distribution list, and then you have to go back, make
There's
sure the
at
bank
least
has
one
done it.
deal I saw, I forget the name of it, but that NASDAQ came in after the fact and said you violated our rules. You didn't do a public offering when they looked at it. And the company made a filing to disclose that, actually.
They did, and I know what you're talking about. But I think they actually, one company did try to get it ratified by shareholders after the fact.
Correct.
And the question really is going to be, and NASDAQ has not, no one really knows whether it's going to be a public reprimand or something of that nature, or a full delisting, but they have, there are companies that did try to get it ratified, and no one really knows if that works or not after the fact. But to Chris's point, go to investors, some of these funds after the fact, after you close the deal, and ask them to change something. It's not so easy to do.
And so NASDAQ, again, the reverse split question. NASDAQ has, you'll see all the companies doing the reverse splits are all these NASDAQ companies. That's the way the discussion is, and they have their limits to what you can do. Versus NYSE, which you won't see it as often because they don't have a dollar price rule. But below 36 cents, there's like one trigger, and at 6 cents, I think they'll delist you.
Yeah.
I don't know CBOE, but it's to be determined. But depending on which exchange you're on, there's different ramifications as to what you can do or can't do.
And last thing, sorry, on your point on the reverse splits, the other thing to think about, and this is something that NASDAQ is applying now, is that their rule is that if you've done more than a ratio of 1 to 250 in a 2-year period, what will happen the next time you go below $1 is they will not give you a 6-month relief. You'll have to go straight to an appeal process. The thing that's interesting about that is that it's actually, you multiply the ratios. So if you did a 1 for 10 and a 1 for 25, you're done, right? Next time you're going to get a letter, and you're going to have to go straight to an appeal process.
So what are we seeing? We're seeing a lot of companies that are in a difficult position with their listings at the same time as they're trying to raise capital.
Are they going to the NYSE more often now because of the more difficult climate at NASDAQ?
I'd say some underwriters and some companies, but I don't want to say more often. There was a flock for a while, but NYSE listings are difficult as well and not as flexible, and there's more reporting. So you might be able to get listed there easier because you can go through the process, but once you're there, it has different issues with it as well.
With all of these challenges, are you seeing more the reverse mergers that were real popular more than a decade ago? Reverse mergers with public shell companies? Or not even shell companies?
Yeah, we're still seeing them. I think, we talked about before we got up here, there's been some guidance put forth by the SEC on SPAC transactions, and some of that has started to been applied to reverse merger transactions. But there still are de-SPACs getting done, and there's still reverse mergers getting done, and then there's a question of whether the SEC is going to essentially apply some of those SPAC rules to reverse merger transactions, and when the asset of the company that is the NASDAQ, I won't say shell because there's no such thing as a NASDAQ shell, right? But the NASDAQ vehicle, when that asset goes out.
Yeah, and you're seeing this a lot really you're really seeing it a lot in the life sciences space with companies that have had failed trials and now have either another asset that they're looking at, but really are looking for some way to try to create some value. There's lots of private companies out there because the IPO market is so poor right now for microcap companies that there is a lot of activity, to your point, Lynn, is a lot of activity in call them reverse mergers, but they're merger transactions with already listed companies, and we are seeing a lot more activity in the M&A space because of that. And but the structures have changed, and to Chris's point about the SEC rules, they were lots of deals done as signing closes, and then structured in a way that you could do the deal sign and close now, announce it, and then get through the compliance, NASDAQ compliance, and all of the SEC requirements after the closing. Some of these rules that come into play are really meant to get rid of that sign and close transaction and make you go through a more formal S4 registration process, which is the way the SEC wants it done. NASDAQ has started applying some rules to it, so I think you're going to see we're starting to see it now, a number of deals we're doing internally that we did do one sign and close, but we're doing more S4 registrations on those transactions.
So I'm smiling about it because I'm thinking back 20 years ago at the reverse merger conference where we would come in and we'd talk. There were a lot of reverse mergers. They're not reverse mergers anymore. They're mergers. You might want to call them reverse merger because it's a reverse takeover of a company. But with the SEC new rules or the SEC's new position that if you bring a company in and dispose of your business or intend to, you're a shell all over again, even if you weren't before, you don't see those transactions as much. You'll see transactions where people are merging and staying together, trying to build a company around a financing, trying to find a way to stay listed and do a financing because people need a way to get money to be attracted to the deal now.
And they have to stay together, has been my experience,
have to stay
because the SEC wants to call everything a shell.
Correct.
Yeah, it has to be more, you have to be a little more strategic about building a deal. So you have to look at a consolidation and some synergies between the existing business and the target. I think a completely different business shift is very difficult to pull off in this market.
And then we used to do reverse mergers on the OTC markets, the pink sheets, whatever you want to call it, OTC markets. If you do one, it's perilous because you could merge into a company and now you have to deal with FINRA. If you want to change your name, if you want to do a reverse split, if you want to do any kind of corporate action, that's a 6-month process. It literally took 6 months for a company to change its name. An operating company that had a business that wanted to change its name, FINRA sat on the paperwork for 6 months.
It's just a name change.
Just a name change.
That's all.
And so imagine you want to do a reverse split. It's so hard that it's hard to get a deal done in the market because FINRA, yet another understaffed and overworked agency.
It's become the
can't help you.
bane of many companies' existences. They just want to do something simple, and you are literally stuck in FINRA. They no longer give you a dedicated examiner. Like at least at the SEC, you have someone you can call and ask questions. FINRA now has these blank emails, and it just sort of goes out into the void.
If you're lucky, you know somebody there. And if not, those same advisors who do work for the NASDAQ companies, some of them have FINRA experts now too. And they're all whatever employees or senior people there.
You can say who it is. It's okay. But yeah, no, I mean they're extremely helpful. Honestly, we use them a lot on our companies that are. I think every one of our companies now that is running through a NASDAQ issue, we utilize those resources. So they're incredibly helpful because they do have a direct line into the key people at those places and get those things done.
None of us are going to tell you they know more than we know how to do it.
Right.
But those contacts make a big difference.
These new rules that the SEC has proposed, they're becoming effective in July. They're primarily for SPACs, but they do also apply to shell companies. We'll just call them shell companies. But blank check companies, companies whose sole purpose is to merge with or acquire another company. The rules are onerous. I was quite shocked. I was reading them on the plane on the way over. It's almost like you have to do an S4 registration statement
or every acquisition?
So I was talking to somebody outside earlier who's doing an acquisition, and the acquisition is for cash. But the SEC thinks that because they were going to get rid of part of the business, that it was a reverse merger with a shell. And there's no securities being issued, but the SEC was like, wait, you have to file an S4.
Wow.
And the attorney's like, why? We're not issuing any securities. That's how confused the SEC is about their own rules.
And they want to call everything a reverse merger and everything's a shell, even if it has an operating business. It's rough.
So, we're lawyers. I know we're being pretty negative. It's a tough market. I'm just going to stress that deals are getting done, but just be wary. I mean, you need to have good securities attorneys on your team. You need to have good accountants, good IR professionals, all of that, because it's much harder to just throw a deal together. And then you stumble into these issues if you have inexperienced counsel or folks that don't deal in the microcap space that aren't aware of these issues. You won't spot them ahead of time. So it's tough to pull off deals. Deals are still getting done. And I would just say you just have to have the right team that understands how to navigate it, who to talk to, and what the different exchanges are and how they operate to be able to pull this off.
So if you're a CEO of a company trying to get a financing done, if you're already public, your options are one set. If you're trying to go public, it's an IPO. You just need to be prepared. But if you're public and you're on NASDAQ or NYSE, you need to know what all your options are, whether it's an ATM, an RD, an overnight, an at-the-market deal, a registered public offering. And literally, you may want to be in a position to be prepared to have documents done, because any of those deals can be done in a short amount of time, very short amount of time. When I say, if you wake up in the morning and your stock's trading whatever amount of shares, many of you, it's happened probably, you get calls from 5 different bankers, which one should I go with? Right. And you have to be ready to do that deal by 3 p.m. Mm-hmm. And if you're not, okay, and the day comes, now you look back at your 5-day average, you may still get it done that night. If not, now you're talking about a different period, and you're always, but understanding what you can get done and the cost of the dilution if you do it other ways is very important, is what I'd say, upfront ahead of time.
I'm seeing more Reg A offerings. I'm doing more Reg A offerings now than ever. And yes, if you do a Reg A, quote, public offering, you can only trade on the OTC. But at least you get the liquidity. And it's sort of like when you buy your first starter house and then you have to step up, buy an uplisting, get a bigger house and list on an exchange. I'm thinking it's become a real popular way to go currently, because the Reg A offerings are getting through the SEC quite quickly in my experience. I'm averaging no comments to maybe 30 to 60 days. Are you gentlemen experiencing the same?
I can't say I've been doing them, only a few. There's a couple, one that's raised a lot of money, more than most anybody. You'd think of like the $100 million range over time, but it's a great alternative. I think more people should adopt it, but it hasn't been fully embraced by the banking community yet.
Exactly.
So if you're an issuer and you can do it, and you have a product or something you can market off of a platform and raise money, it's a great way to go. Have you seen any non-OTC, like NASDAQ companies doing it?
I have not.
Okay.
Even though they could, they're
They
eligible.
can, that's why yeah.
And now I'm seeing these broker dealers who are primarily handling Reg D private placements on, their platforms. They're now crossing over, now they're doing the Reg A. And not only are they acting as broker of record, but they're acting as placement agents as well. So it's helpful. But Richard's point is well taken. Often when you do the Reg A, you got to do the selling yourself, get a marketing company.
It's 50-state blue sky if you do tier 2, which is great. I mean, for an OTC company, you wouldn't be able to file an S1 because you'd have to register state by state. So
It's an exempt from qualification in all 50 states.
Have
Right.
you guys seen any?
Yeah.
Go ahead. No, Chris.
Yeah, so we've done Reg A's less to necessarily go public. I think there's a kind of a cottage industry with some of these different verticals and platforms. Like we have a client in the racehorse industry that kind of do these serial Reg A's, and it's a little bit of a different space. I think, as both of you have said, the banking community hasn't necessarily embraced that as a path. So I just think until that happens, you're not going to see that many Reg A go public.
I think until either bankers adopt it or it's readily available on your phone and anybody could buy a Reg A with an app. If that happened and everybody could invest, the younger generation might do it.
But the compliance infrastructure is pretty sound. I mean, there are these smaller broker dealers that are doing the 50-state blue sky survey, and they're There's a handful of states which have issuer-dealer registration issues that are really tricky, and they can kind of circumvent that. So there is an infrastructure in place if there is buy-in.
I think the point, though, is that ultimately you're going to have to uplist and do a re-IPO, really, is what the banks have looked at, right? The banks that are doing this are taking those companies and then doing their listing after their Reg A offering where they raise some capital.
I'll also add it, because I did it for one issuer. They did their Reg A, and then I did a re-IPO, which was a proper IPO. It was the best performing IPO of all the IPOs I've done in a couple of years. Why? Because the people who owned the stock in the Reg A cared and wanted to invest more. And when it went public, there
were
was a liquid
long-term
market
holders.
that didn't exist for many other companies that you don't always see. So it is a means to help
It's
build
a
yourself.
legitimate alternative that gets done. Maybe you don't raise as much money, you don't have the help of a big bank, but it gets you there. Sort of as your starter public offering.
It's a marketing job. If you can market your company, because there's dollars invested to get eyeballs, to get investment. If you have the right company, right product, if you spend money, people are going to invest.
Is there any advice for the audience, things to look out for in engagement letters for issuers? Should they undertake any of these transactions we're talking about?
So, yeah, I mean, listen, you're gonna, depending on the banks you go to in this marketplace, I mean, the biggest issue really for most companies in signing engagement letters are ROFRs and tails, which really, it's interesting because we have a lot of clients that come and say, well, the bank promised us no ROFR, but they're gonna get a tail. I'm like, okay, well, it's just the same, right? Because the investor base that they're going to in this marketplace is the same, with all the banks, right? You go to one bank, they're going to the same investor base that the other bank's going to be going to. So the thing you really have to watch out for is, and I think lots of companies have gotten caught with this, is that they don't think they have a ROFR and they just have a tail. Now, yes, you can still hire another bank, but you're going to end up paying twice for the same deal. So the other thing to think about is when you have a ROFR and a tail, is to make sure that they are on the same term, same length, because otherwise you run into the same problem that I was just mentioning.
Yeah, the only other thing I'd add is the term of the engagement letter. How long you're engaged for and when does it last to.
The exclusivity.
Those are all important things to think about.
Yeah, certainly the exclusivity, certainly the
Right.
scope. Most of them are as broad as possible, covering equity or debt securities, but if there is alternative transactions short of using a bank that you would consider, if there's private money, then you want to look at that in the engagement process.
Yeah, scope's a good point. Be careful. You'll go in thinking you're hiring them to do an equity raise, and they will throw in
Or
the kitchen sink of
they'll
other
throw in
things,
an M&A.
including M&A.
Yeah.
Right.
Right.
You want to
And on-
negotiate those things and limit it.
Yeah, on the term, really, it's a really good point. I think that the thing to think about is what is your plan in terms of what you really need and how quickly you need to raise money. And a lot of these banks will tell you, well, we could do it in 15, 20 days, 30 days, and make sure if that's the case that you have a short term, because we've seen that, and then you get an engagement letter and it's a year term. But the banks that say they could do it generally will shorten the term to make it a much shorter term.
And if you're stuck with that term and they can't do it, you need to go to another bank. Now you're negotiating your way out. That's the same thing on the ROFR as well. ROFRs are written very trickily depending on which bank you go to as well. So you need to be careful about that.
Unless there are any other comments from the panel, I'd like to open it up to questions.
Great.
Yeah, have you worked with any companies that are doing crowdfunding platforms? What are your thoughts on that?
So 506C, like general solicitation,
Or Reg CF?
I represent a public company that's their business. They bring in companies and do crowdfunding for companies. Then there's other platforms out there, Dalmore being one, Start Engine another. There's a bunch of them out there that do it. Yet again, it's another good way for a company to raise money when it's private and get a shareholder base, but you're usually talking about smaller amounts of money. But it certainly is a way to fund your company to start when you're on the big. A lot of companies do the 506C and then go to a Reg CF and then to a Reg A. There are companies that you need to be careful when you do that, though, because when you get too many shareholders at some point, you fall into becoming reporting. So it's just the only. But yeah.
Yeah, you have to manage your cap table if you go that route. Private equity looks at 1,000 people on your cap table and their head can spin. So you have to be careful if you're going to go down that path. You have to stick to it. You got to deal with, non-voting securities or something to put those folks in a bucket to where they won't impact subsequent transactions like a go public transaction. I mean, if you have multiple thousand shareholders, each holding $100, taking them through the go public process is difficult. So
If you think you're
be
going to go
careful.
public, yeah.
Yeah, if that's the path.
And then an underwriter wants lockups from them all, so. yeah.
Well, that's the problem, right?
I have a question about public policy. With so many companies facing delisting, hundreds of them, with troubles with the de-SPACs, with troubles with reverse merging into a SPAC, it seems to, and with what we've heard in previous sessions today, that rates have impacted the micro-cap and small-cap companies, that the economy has affected them. At what time does our White House step in and start to say, we need to relieve the pain here? These companies have spent a lot of money on getting public, are spending a lot of time on trying to form capital, and the exchange restrictions, the rules, and everything that are here need to be suspended a little bit to give them some breathing room and to earn back what they spent on getting public.
I mean, if you remember, at one point, NASDAQ did drop the dollar, minimum price for a period of time.
And the 19.9.
Yeah, and the 19.9. Listen, it's hard to say, right? But there are restrictions. I think the biggest problem right now is not necessarily the deal structures. I mean, deal structures are difficult, right? But I think there's very smart people out there, including the people on this panel. There's lots of smart bankers that try to figure out ways to get financing in. I think the biggest issue right now is that there's just not that much capital out there. I know it sounds very negative, but we see it on a regular basis. And if you look at the number of companies, to your point, that are that can't meet stockholders' equity, that are trading at $1 million market cap. It's a lot of them, and sub $10 million, and it's a lot of companies out there. I don't know at what point some of those things easing up would certainly make it easier, right? I think the biggest issue, and we've raised this for years, is the requirement to reverse split at below $1, right? The amount of value that companies are losing doing that reverse split, and you have companies with that have a big market cap, right? It's not even its market cap, it's just $1 stock price, but for some reason that was enacted. The SEC required NASDAQ to do that, didn't require the NYSE to do it when NYSE bought the American Stock Exchange. That was not a requirement. So I think that's something that we've tried to, we've talked to people about, right? It would be great to get rid of that one for sure.
I can add a lot, but go ahead.
Go ahead, I know.
No, you covered it well. Steer clear. I think it's just tough. A lot of it's market driven, and at some point, the companies that can, stabilize their business, bring in capital, even if it's not on great terms, persevere. They're going to come out better, and some won't. And so at some point, that's kind of the result that's going to happen, and the market's going to kind of drive that.
So to your question, I don't think the White House ever steps in. But our SEC commissioner, depending who it is either pro-capital raising or not. Our current commissioner is much more aimed at regulatory and enforcement and whatever. The prior commissioner was more pro, but that's only one out of all the commissioners of the SEC, so they have a debate about it. The exchanges, like he said, have a different view. And so NASDAQ did give some relief at some point. Okay, sure. And NYSE is very different. It really just depends on where you're coming from, because there's a lot of different ways to come at it, but I don't think there's a simple answer to, it's the economy has to get better, but that's not really an answer to your question, per se.
That happened years ago when we had trouble getting DTC clearance, because DTC, remember that?
Another mysterious agency that was chilling stock.
they had an
They're still out
exclusive.
there, actually. And if you do a reverse split, your stock is chilled for a short amount of time,
But they're better
not the
now
same
than
way.
they used to be. But somebody needs to do that with FINRA right now, because the company should be able to change its name. It's an amendment to your articles.
I have a question. I'll throw another fish into the pond.
All right.
Thanks.
You've got all of these questions coming out of the audience about reverse takeovers, reverse mergers, this, that, other underwritings and secondaries and Reg A and all. But it just seems like it's created a cottage industry of shorting. And, you know, how does, you know, you've got naked shorting on an announcement. You've got naked shorting prior to the announcement. You've got naked shorting between shorts. I mean, it's, you know, I don't think we could avoid this question on this panel.
So I'm not a trader, and I don't know that I know. I hear lots of things about trying to cure the shorts or fight the shorts. Forget that aside. Naked shorting, I'm sure it exists. When you're going out to do a deal, mysteriously before your deal has ever even launched, how much does your stock price go down? So clearly, people who have information are selling the shorting. And then throw another angle at it, warrants. Every time you have warrants in a deal, if they're registered, the shares underlying those warrants can be shorted against. So the investors who get a share in every warrant for each deal that they do have a built-in mechanism to short against if they're registered. And so some people think that, here, we'll give you more warrants, you'll raise more money, second tranche, third tranche, think of all the money you can raise. On the other hand, some of these investors, not all of them, probably use those warrants and sell stock. And if your stock goes down, they cover from the market. And if it doesn't, it runs, sure, they'll exercise their warrant and they'll cover and still make money. So it's with all the warrants out there, it's very hard to answer how do you cure it. I mean,
It is a question that we get asked all the time, and I don't think we have a really good answer until the SEC tries to enforce it. You know, it's going to continue. I mean, there's no way around it. It's something that's out there. And to Richard's point, I mean, you see it all the time, and it depends what bank you're talking to and who you go to. But the amount of the fact that it's a confidentially marketed deal, we're not even talking about S1 deals, we're talking about a confidentially marketed deal, and once you start going out, you see that dip in the stock price. It happens all the time. And how does that happen continuously, right? So until there's some enforcement actions, you know, that's going to continue.
Look, I'll just add, the regulatory hurdles we've been talking about don't help, right? If you are below $1, everyone knows you. If you don't miraculously turn around your stock, then you're gonna have to split it. So someone can set up a schedule and use the regulations to short the stock. So it's systemic in that regard, and it's not changing anytime soon. So it's just something that is inherent in the market, but we see it. I mean, we see the value loss on these steps, and we see the short. It's an obvious short position with these steps when these companies go through these tough times.
so back to the bright side,
Yes,
which
let's
is
not end on shorting.
there is opportunities to raise capital. There are bankers out there that can help you, and you need to be opportunistic. When those opportunities happen, you need to be able to execute on them fairly quickly, efficiently. If you're not in a position, then something else is going to happen, and it's going to be more dilutive. And that's really the key message that I think I'd send to people. There are opportunities to raise money. You just don't raise more than you need because it's dilution, but don't raise less because if you think you're going to the next milestone, you need to be prepared beyond that because things happen. So you need enough to get you to that next thing, which hopefully is a trigger, and build your business. I mean, and tell your story. You need to be out telling your story.
There are many alternatives out there today that we didn't used to have, like Reg 506C. You can advertise now. We never had that before. So there are opportunities out there. There are alternatives. Just have to be flexible. Deals are getting done every day.
I go to conferences like this a fair amount and sit in the rooms and watch the presentations. I would just say, at times, some of the presentations with the screens, the slides, whatever, that doesn't translate. What translates is what people talk about. If you can connect with people and tell them your story in a way that matters to them, that's going to help you better than anything else. So taking the time to make those slides and stories streamlined and more effective is what I think is a really good idea for people.
Excellent advice. Thank you, gentlemen.
Thank you.
Thank you all.
Thanks all.